Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. We go back to Friday, very strong payroll number. We move forward this week. Obviously, all eyes will be on CPI. The Fed chairman has told us that he's got an asymmetric bias toward employment. In other words, what does that mean? It means that he sees a scenario whereas the employment picture could still remain very constructive and at the same time lower rates. But with that, in conjunction with that, if the employment market weakens, the Fed is biased here, I think, to lower rates sooner than later. So what does Friday's number mean right now? Friday's number means that the timeline for the Fed is likely pushed out. We got a close eye on CPI this week. So with that, we went back and did some analysis on 2006 and 2007. I traded markets very aggressively back then, very involved. If you look at what the market is doing right now, the Treasury market, if you look at some of the volatility in the market, it's really not doing anything differently than what it did back then. The difference is when you look at 10-year space, if you look at 10-year nominal yields, we traded in a range of 4.50 to 5.25% back then. Now we're trading in a much lower range here. But the volatility and what we're seeing right now, and if you look at the market reaction in terms of what the Treasury market did following the payroll number, we're not doing anything here differently than we did back then as we try and sort through the Fed's pathway and what their ultimate intentions are. With that, you look at the market back then. You look at the market here now. Back in 2006, 2007, we had completely different dynamics with regard to the housing market. We had completely different dynamics with regard to the labor market, but net, we have the same Fed funds rate. So the market, looking at the dynamics now versus then, you look at the same Fed funds rate, in the end, we have the same end game with regard to where the Fed has moved things to, but we have completely different dynamics with regard to where the economy is at. The highlight this week is going to be CPI, and people are going to be honing in on CPI because Chair Powell told us that he could ease potentially in multiple different scenarios with regard to the employment data. So now the inflation data carries a much more different dynamic, if you will. We have looked at the core PCE and have written to clients that 0 to 0.3 with regard to the core PCE is where the Fed needs to be. That's where we were at when Chair Powell made his pivot in late 2023. That's where we need to get back to. So we believe anything in and around 0.3 to slightly higher is going to be problematic for this Fed in terms of bringing rates down, although we think inherently, we do think Chair Powell would like to bring rates down, would like to bring that Fed funds rate down, but we need to see cooperation now on the inflation side. In terms of overall market conditions, our biggest theme to start 2024 was the cheapening of Treasury securities versus other assets. It's worked out really, really well. If you look at credit spreads, if you look at mortgages, if you look at other assets, even equities, things have done pretty well. They've done pretty well because the economic data has been very, very good relative to expectations. If you look at the interest rate structure in general, you look at what we're doing on the fiscal side of the equation, we are still running deficits in the range of 1.7 to 2 trillion at the same time that the economy is still doing very, very well. There's nowhere else for the Treasury market to go here but to cheapen on a relative basis. So long as that is orderly, I think markets are in good shape. But if we find a way here to reprice ourselves in Treasury space 50 to 75 basis points, within a very, very quick time frame, I think that's where we could potentially run into trouble. We're not there yet. Like I said, the repricing short term has been orderly, and we hope it continues to be that way. But we're on the lookout for something here in terms of a higher rate structure where things move disorderly, and then I think you could see a spillover to risk assets. Wishing everyone a great week ahead. I'm Greg Faranello. I'm the head of U.S. rates for AmeriVet Securities.